let's say you have bedrooms, and in the bedrooms there are beds and other furniture. The appraiser would exclude the beds and the furniture. Those cannot be included in the value because that's not part of the real property. That's part of the business. We didn't know it when we bought the loan because we didn't get the paper. We didn't see the paper. We found out afterwards, years later, when the loan defaulted. And it turns out there were real sales that the appraiser could have used, but they were much lower in price than what the appraiser invented, so to speak, right? First you want to do is just avoid losses. Don't make bad loans. And if you don't make bad loans, you won't have to worry about how to handle them when they default, because they won't default. Let's say you're in a small town with one appraiser and that guy decides to go on vacation or gets sick and has to go to the hospital. It's like you're stuck. Your mortgage market shuts down, or can you find an alternative, right? And this hybrid appraisal can help create some flexibility in those kinds of situations.
Episode 31 of Market Moves with Mark and Jeff. Jeff, the government-sponsored enterprises, Fannie Mae, Freddie Mac, have been all over the news and the headlines over the last several months. I think discuss more than I've seen in the 2.5 decades that I've been into this. It's been a wild time and isn't going to get any quieter. And we are very fortunate to have with us today Senior Director of Collateral Policy, Lyle Radke. Lyle, welcome to the show.
Thank you for having me.
You bet. So those in appraisal, those that attend appraisal conferences or listen to webinars that are held, likely know Lyle very well because he is out talking about what Fannie is thinking, what Fannie is doing, and how it might affect appraisers one way or another. But for those real estate professionals that may not be as connected to appraisal, I know Lyle, I think, and correct me where I'm wrong here, as someone that is deeply involved in the collateral policy that Fannie Mae is setting out. What appraisals look like, how do they order them, how do they deal with other non-appraisal type products that may come in. And so we're really fortunate to have you here today to talk to us a little bit about what's going on.
Well, you're too nice, but I'm always happy to talk about this. It's my passion. I love to educate on appraisal matters, and really I'm fortunate that in my role I'm an active participant in our policy development and our product development. So I get to see the sausage making, and that helps me to be able to have something to share when I talk with audiences like yours.
Well, we really appreciate you coming, Lyle. Looking forward to the conversation. I thought it would be interesting to Mark and I, probably from the time we heard our dads talking about appraisal, had heard reference to Fannie Mae, Freddie Mac, but I think it probably took a long time and a lot of experience before we got some cursory understanding of what the company is, what Fannie's role is in the residential real estate space. I'd love it if you wouldn't mind just from a high level kind of explaining what is Fannie Mae, what's their business model, and how do they make money? What's Fannie's role in this whole thing?
Yeah, I share your experience. As an appraiser myself, for many years, I said I'm adhering to Fannie Mae guidelines for certain assignments, the lender would ask us to, but without really understanding who that counterparty was. So I just got an email this week that Fannie Mae is celebrating our 87th birthday. We've been in business for 87 years, and we were created during the Great Depression by the Roosevelt administration as an antidote to, or a cure for a problem that they were experiencing in the banking industry. And without rehashing all the ins and outs of the Great Depression, the essence of it was, prior to the Great Depression, most home loans were 5-year balloon payments. So you pay a mortgage for 5 years, and then after 5 years, the principal or the remainder will be due. And if you happen to have a lot of money, you might just pay that off. But in a lot of cases, people would refinance at that point, and they get a new 5-year plus balloon, right? And this is because the banks were concerned about overextending their capital for too long of a period of time. Hard to predict what interest rates might be in 20 years. And so if you're locking in an interest rate, you want to lock it in on a short time frame so that you don't get burned by, let's say, inflation. So all of these balloon payments were coming due during the Depression, and people didn't have the money, and the banks were looking at credit conditions, and they weren't refinancing. They're like, you're unemployed, I can't lend you more money, so pay me what's due or else I'll take your house, right? And then they had a foreclosure crisis. Many of us remember a subsequent foreclosure crisis in 2008 through 2010, right? So, but the government at that point said, well, we need to find a way to get banks to do mortgage lending again. And they created Fannie Mae. It is not a government entity. They created it as a private corporation, but it has a charter. So we have a federal charter, a congressionally passed charter that is like a law that tells us what our mission is. And so we operate in what they call the secondary market. And essentially what we do is we buy mortgages from banks and other what we call primary market lenders. So if you want a mortgage, you go to the bank or the mortgage company of your choice and you say, I'd like to get a mortgage. And they ask you a bunch of questions about your credit and your house and your income to see what lending program you might be eligible for. And what they're thinking is they're not going to hold this loan. Let's say they give you a 30-year mortgage. They're not going to hold this loan for 30 years. They're going to transfer this loan to somebody else so that they can recoup their money so that then they can loan to somebody else, right? And that the options for who they can sell this loan to include Fannie Mae. In fact, we're one of the principal buyers of mortgage loans. So we're not a government entity. We're not a regulator. We have no police powers. But as a company doing business, we get to set the contractual terms of business. So we say to the lender, we will only buy your mortgage if it meets these underwriting criteria. So we tell them what the credit rating has to be, what the down payment has to be, what the debt to income ratio has to be, all these kinds of things. And part of that is we tell them what the collateral terms need to be and what the loan to value ratio needs to be. So when we talk about collateral in this context, collateral can mean different things to different people, right? But in this context, collateral means the loan is secured by something. So in this case, the loan is secured by the house. If you're going to buy a house, you pledge that house as collateral for repayment. If I fail to make the mortgage payments that I've committed to, then I have agreed that the lender can come and take the house in order to recoup their money. And that's what a mortgage means, right? So when we talk about collateral, we're talking about the house. Is the house suitable for backing up or guaranteeing this loan? And the way you find out if that house is suitable is you need to know, first of all, the value, right? If I'm going to loan $200,000, that house needs to be worth more than $200,000. Otherwise, I won't be able to recoup, right? In the event of a borrower not making their payments. And similarly, if Fannie Mae's charter says we only buy loans on 1 to 4 unit properties, I need to know that this is a 1 to 4 unit residential property. I need to know that it's not a McDonald's or not an office building or not 5 units. So these things need to be verified by the lender before they sell us the loan. Also, we have condition requirements. So the house has to be livable, habitable. Has to be in reasonably good condition. You don't want somebody. It's not really within our mission to say, oh, the house is in terrible condition, nobody can live in it, so we're going to make like a commercial loan for you to buy the house, to go in there and then rehab it and resell it. That's not that's not our mission. That's not what Congress wants us to do. We're really intended to be providing liquidity for someone who's going to live in that house or perhaps rent it out, not somebody who's going to flip it, right? So all of these things are part of determining the collateral. Is the property suitable for our mission, our, what the Congress has told us our business model needs to be, and then also for repayment. And as a result of this, when we get the collateral right, what it does is it reassures the capital markets, which I'll talk about that in a minute. And by reassuring the capital markets that their money is safe, then that means they will lend money at a lower interest rate. So our policies, our underwriting policies have the net effect of lowering interest rates for everybody who's eligible. And that's really the social good. We ensure that there's always liquidity in the marketplace. We're always here. We're always buying mortgages, whether it's a recession or a depression or, expansion. We are here making sure that there's a functional mortgage market. And we're also ensuring that those interest rates are as low as the market will bear, because we are providing a guarantee and an assurance to people who have money, who want to lend money, that they'll get their money back, right, with interest.
That makes sense. In fact, I have kind of a funny anecdote. We got an appraisal request for an appraiser, I think in Ohio or somewhere, to appraise our property, for a potentially a loan that, might find its way to Fannie Mae. And it was clearly a kitchen or like a commercial restaurant, right? But it had a little apartment above, and they were trying to get a residential mortgage, on this property. And so I joked with the appraiser. I said, just call that the kitchen and the dining room and then the living area upstairs. And, we laughed because we knew that wasn't really what this property was. And of course, told the mortgage company, hey, look, this is a commercial property in a commercial zone, filling a commercial need. We can't do, it would be inappropriate to do this as a residential property. And some of those things as appraisers, we just kind of take for granted. Like, yeah, we know that is going to be a problem and that we shouldn't appraise it or call it something that it's not. But I think your perspective really helps in understanding what your charter, whether mandates or clarifies the role is, the type of collateral against which you can loan, against which you cannot loan. I know working farms and, like agricultural properties will become an issue. Oftentimes appraisers will get questions if you've got a house on a rural setting, is this a producing farm? Is this really an income, property of a different type? Because I imagine that your charter, precludes from making like working or operating farm loans as well.
Yeah, that's a kind of a tough question. Like, where do you draw the line? And I'll
Sure.
Maybe this isn't our main focus today, but since you brought it up, let's say that one of my neighbors, today I live in suburbia, right, on a city lot, but previously I lived in kind of a rural area, and one of our neighbors had 20 acres and they had a bunch of goats, right, and they were making goat cheese and selling goat milk and selling goat meat and selling goat wool, and they had an operation there. But you can only have so many goats on 20 acres. Like, it wasn't a very big operation. And if you were to shrink that down a little further, let's say they had only 10 acres and their kids were like in 4-H and raising a handful of goats. Is that a farm or is that a hobby, right? And so from the underwriting perspective, if it's intrinsically a farm and the residential use is incidental, then that's not eligible. That's a business, right? But if it's intrinsically a residence and the agricultural use is sort of an accessory to that, it's a hobby. It's a small operation. It's not self-sustaining. Like, you tore that house down, would someone buy it as a farm? If the answer is no, it's just not big enough, it just doesn't generate enough revenue, well, then it's a house, right? And then it's eligible. So there's policy around this and tools in the toolkit for how to figure out where to draw that line. But certainly it is part of our mission to provide liquidity in the rural market. And in rural markets, a lot of properties have sort of this mixed use characteristic, and that's okay. It's okay up to a point. Like I say, that point is when the agricultural use becomes to the degree where the residential use is just immaterial, where someone would not care if they had a house or not. Right.
pushing that boundary, Lyle, over the last year, well, I guess more than a year, several years, has been the short-term rental, Airbnb, VRBO stuff, it seems, because you've got investment property that is pushing right up and then challenging the boundaries. I know there's been additional guidance on what the 1007, the form that we use to kind of analyze rental income for properties, what it can be used, what it's designed for, and what it isn't. So we seem to be, that's a difficult one that the target moves a little bit there as new things are invented.
That's another great topic. And we published an article we have a quarterly appraiser newsletter that we publish. And in our July, I think June or July 2024 issue, we published a little article on this very topic of the short-term rental or the Airbnb, right? And it's pretty nuanced. Physically, if you walk into a lot of Airbnb or short-term rental properties, it looks just like any other house physically, right? But the usage here might be more aligned with like hoteling. So the property itself may be eligible. There are some questions that the lender needs to ask around the borrower and what the borrower's intention is. And is this a mortgage loan to buy a property, or is this a mortgage loan to support a business? You really have to separate out those two things. And I think that spills over into how it's valued. It needs to be valued as a property and exclude anything that is, let's say, a contributory value from the business. So an example would be, let's say you have bedrooms, and in the bedrooms there are beds and other furniture. The appraiser would exclude the beds and the furniture. Those cannot be included in the value because that's not part of the real property. That's part of the business. The owner of this Airbnb may have like a brand. They may have a website that drives traffic. They may offer services. I one time stayed in a short-term rental, and they had water bottles in the fridge and a basket of snacks, and they have towels and shampoo and cleaning service and all this kind of stuff that goes with it. If that's increasing the cost of the transaction, like if I'm buying this short-term rental and I'm paying to inherit all of this business operation and branding and so forth, then that purchase price is not representative of the actual real property. It's more than the property. It's the property plus the business. But Fannie Mae cannot, based on our charter, we cannot subsidize the business. So the lender has to separate these out, and they have to say, here's the part that's the residence, the real property. That would be the baseline no matter what you used it for. You could use it for your own personal residence and it would be good at this value, right? And all that extra stuff associated with the business, they have to exclude it from the loan.
Yeah, maybe just one last comment that I have on this topic. And I think your framing of Fannie's charter and kind of what is permitted and not, it speaks to a couple of things. One, your residential mortgage rates tend to be a little bit better than the commercial rates for a commercial type of a loan. And so when we have properties that are on the fringe, whether it's a lodging facility or a quasi-commercial facility, a working ranch, type of facility, I understand why a borrower would like it to fit in this bucket of, hey, I can get a better rate on a 30-year residential mortgage than I can on a commercial loan, which actually mirrors a lot more what you described, Lyle, before Fannie's creation of, this kind of 5-year balloon payment, structure is pretty common in the commercial space. If I want to go buy an office building or something, I'm going to be renewing that loan every, 3 to 5 years, depending on the terms. So we deal with that a lot. And I think a lot of times the end users don't understand why we can't just say, well, it's got some residential component, therefore it fits within this residential box. And, they've got a financial incentive to want it to fit in that box, but it just doesn't always. But so interesting, and appreciate your kind of framing of, how things came about and why, how that leads to why certain decisions are made, the way that they are today.
And I think it's helpful to remember where the money's coming from. A lot of the money that gets invested in Fannie Mae bonds that we use to acquire mortgage loans or to fund the mortgages in this country is coming from like teachers union retirement fund, people's 401k funds. It's like it's real people. It's ordinary people who are saving money and who are investing it in the mortgage business. They're lending the money. They're essentially the lenders of the money, and Fannie Mae serves as this person or this entity in the middle to connect the money to the people who want to buy homes. And the important thing here is honesty and transparency. There's a different risk profile for a commercial operation than for a residence. My own personal residence, my castle, right? I'm going to do everything I can to make sure that I don't default on that loan, because I need a place to live. And I like living here. This is where my friends are. This is where my job is. This is where my memories are. This is where all my stuff is, right? So people will fight tooth and nail to save their home. They're not quite as passionate about saving their business in a lot of cases. Business tends to be a little bit more of a cold, hard calculation of, am I making money or not? And if I'm not making money, what's the best off-ramp? So interest rates intrinsically should be higher for a business purpose, because the risk of not getting repaid is higher. And what the people who invest in mortgages, again, a lot of these are people just like you and me, people with 401ks, people with pension funds, people with retirement assets, savings. They want to know the risk of what they're investing in. And that's part of Fannie Mae's job, is to make sure that our underwriting requirements are met, so that we are honest with them when we represent a risk profile that they can invest in.
It's I think really useful for those participating in the market to think about from this kind of back to basics viewpoint, because it is, you are, Fannie is, and Freddie are trying to create a box to fit things in that it gets the cost down by kind of commoditizing it. Everything looks very similar to one another. And so because of that, it's very familiar. We only get it in if it fits in this box. And obviously that reduces the cost all the way around.
Yes, exactly right.
And so I have one more question on this topic. I don't know, maybe a little heady for appraisal centered stuff, but Fannie makes these loans, I think, then packages and sells some or all of them to through mortgage-backed securities, and that is that a way to make more loan? From a high level, understanding that process and that side of things would be helpful.
Yeah, just to be clear, Fannie Mae doesn't make loans. We acquire loans that are already made, or already closed. So the primary market is making the loan, and when they make the loan, if it fits within our box, if it meets our guidelines, then they are free to deliver it to us if they want, and we will buy that, right? And so when we buy the loan, we're giving them money, which essentially is replacing the money that they lent. So now they're free to go lend again. So, but your question is, well, where does our money come from, right? Mm-hmm. And principally, we get money through what we call a mortgage-backed security, an MBS, as you said. In a mortgage-backed security, we're not actually selling the loan, we're holding the loan, but we're borrowing money in, like I say, in the capital markets by issuing bonds. When we issue the bond, an MBS means that we're guaranteeing payment of the bond from the proceeds of certain designated loans. So there's what we call a pool of loans that are affixed to a bond offering. And the income from those loans, the payments that the borrowers make every month, is going to be purposed by Fannie Mae to repaying that bond. Now we get to keep a little cut, right? So let's say that interest rate is whatever, 7%, and the borrower's paying a principal payment plus the 7%. What we pass on to the bondholder might be the principal payment plus 6 3/4%. We might keep that 1/4%, right? That's our share for being the guarantor and managing the whole process.
Illuminating and helpful to me. I think a lot of it is kind of like I let off saying, I generally MBS, I get it, but I think taking a step back and slowing down and listening to what it is, and a description is really helpful. So thank you for that. The last 2.5 decades in the housing market have been eventful, for sure. We had the subprime run up. We had the resulting kind of conservatorship. We have the COVID stuff that's coming through here, and one of the questions we were wanting to tee up to discuss a little bit is kind of lessons learned from these past housing markets in GSE policy. And a lot of that, I think, is in our world, is the question is related to appraisal policy. FOIA waivers have been all kinds of conversations amongst appraisers over the last little bit. But I think as a beginning, in a generally open question, is on the subject of lessons learned from these past housing kind of market events, and what is being implemented from those learnings.
I love that question. That really gets to the heart of what I do at Fannie Mae, and kind of my own career path and journey. You say last 2.5 decades. If you go back to 2000, 25 years ago, I was an appraiser, a residential appraiser, right? Just a typical, what some appraisers will call boots on the ground, out there appraising houses every day and trying to follow Fannie Mae guidelines in a lot of cases, right? When I first started in this business, which is just a few years before that, one of the reasons why I got hired by an appraiser, was because as a young person coming out of college, I had a lot of familiarity with computers and data systems, and he was looking to make the transition from a kind of a paper-based business to an electronic-based business. And so, I was a good fit for helping drive that transition. But at that point in time, our customers, who were primarily mortgage lenders, had very little validation data, what I'll call validation data. So if they got an appraisal from us, they pretty much had to take it at face value. They had no idea if it was right or wrong, other than kind of their own experience, a gut check, if you will, where they would say, well, I've seen appraisals in this area before, and this one doesn't seem to be quite consistent with the other ones. So they're going off memory, right? And they're going off instinct. And they had rules of thumb where if, let's say, the adjustments to the comparables in the appraisal exceeded certain threshold, they're like, oh, that feels uncomfortable to me. No idea if it's right or wrong, but just, uncomfortable because they're large. So the appraiser was kind of in an enviable position of being able to say anything, and they were the source of truth, and the lender had to respect that because they didn't have any other answer. But as you all know, over the last 30 years, with the internet and the .com boom and everything else that's happened since then, we have our United States economy has transformed into an information economy, and now everybody has data. We've amassed huge databases in real estate, residential real estate, and in everything else. Like, this is not unique to real estate, but there are a lot of tools out there now which sit on top of big databases and can provide lenders with a lot of context around the local market, how much properties are selling for, what the property characteristics are, just lots and lots of information. So now today, appraisers are in kind of a more of a transparent situation where the lender could potentially challenge them, right? But let me back up to your question. So 2000, it's like appraiser, living the dream. Nobody questions me. I'm king of my own domain, right? But lenders are starting to get more information. What we saw in the run up to like the bubble bursting, 2002, 2003, 2005, we saw a lot of what I'd call national lenders moving into our local market through probably a telemarketing type model, where they were phone calling lots and lots of people, maybe with subprime credit, offering them mortgage terms, and then ordering appraisals to support those mortgage loans. And I saw lots of crazy stuff happen in that space. These are lenders who had no familiarity with our local market. They didn't have a sense of whether or not what the borrower was telling them was right or wrong. So I remember one day I got like 15 appraisal orders from a company that I'd never heard of before, that was operating on the East Coast, 1,500 miles away. And every one of them was like, the borrower thinks their home is worth $500,000. And, at that time, maybe in New York City, but not in, I was in New Mexico, and it's like, that's a $100,000 house. It's not even remotely close to being worth 500,000. And so I went through all 15 of those orders, and there was like only one of them which was remotely viable, and the rest of them were just completely disconnected from reality. So that was a drag on our business, very inefficient to be dealing with that sort of ignorance. Well, anyway, fast forward, I went to work for a bank in 2003, and the bank had its own portfolio of loans that they serviced. And so I got to live this firsthand. My job was to find out how much a property is worth when the borrower was seriously delinquent, and if they were, in the case that they defaulted, because we had to make some decisions about whether or not we were going to foreclose, whether or not we thought we could sell this property, whether we were going to get our money back. There are other off ramps there, like a short sale or a loan. You could do a loan modification, and all of those options were driven by having a clear view of the value. So my job was to make sure we had a clear view, not overly optimistic, not overly pessimistic, but just rational, true point of view on what that property was really worth right now, today, in its current condition, so we could make prudent business decisions. And that was a fantastic role for me. I learned so much. But we also started to move to more of a digital model, where we're going to get our appraisals in instead of in paper. Like when I first started in the business, what we were doing, I talked about the transformation from paper to digital. It was sort of fake, right? It's like you were taking a world built on paper and paper forms, and you were turning it into a world where you use computers to generate the paper. But it was still ultimately paper, right? And one of my first tasks when I first started in that business is every afternoon I would deliver all of these paper appraisal reports to our local bank branches, right? So we were using computers to generate the paper, but it was still paper outcome, right? And if you think about it, there's a lot of limitations to a paper-based business. Somebody actually physically has the paper, and that person knows what's in the report, and nobody else does, because no one else has the paper, right? So the paper is a responsible thing. But if you're a big bank and you're doing 10,000 loans a month, you have a warehouse somewhere where you're just piling up the piles and piles of appraisal reports. And if you need one, you've got to, have this process with your warehouse to go retrieve it. I sort of picture one of my favorite movies is Indiana Jones, the Raiders of the Lost Ark. And if any of you have seen that movie, at the very end, they've found this ark, the Ark of the Covenant. It's this precious archaeological relic. And the government takes it away from Indiana Jones, and they store it in this warehouse. They put it in a crate, and you see the last scene is them rolling it into this enormous warehouse the size of 10 football fields with 10,000 crates. And they stick this one in there with all the other crates. It's there, but it's lost, right? And that's kind of how your appraisal was. It's there, but nobody knows what's in it. Nobody can find it, right? So if you fast forward then to about 2008, as the housing market really collapsed from this subprime debacle, we started to see a lot of defaults. And the Fannie Mae in particular, when a loan defaults, we look at that loan to see if it was truly originated according to our requirements. And if it wasn't, then rather than us taking the loss, we go back to that primary market lender and say, hey, you promised us that you would underwrite to our guidelines, but you didn't, and therefore you're accountable for the loss, right? So this is built into our process and our contract. So all of a sudden, Fannie Mae is looking at a lot of loans that are in default. And one of the things that we're discovering is that in some cases, the appraisal was not done correctly. Now, that's not the only cause of default. That's just one of many, but it was a pattern and a trend, right? And up to that point in time, we didn't get the appraisal. We were not holding on to that paper copy. We weren't getting a digital copy. The lender was sending us 2 or 3 pieces of information off the appraisal. They'd tell us what the value was and what the property address was, and 2 or 3 things like that. So we had a very superficial understanding of the appraisal. And now we were finding out that that substantial amount of loss was going to be due to appraisals that were not compliant with our guidelines. Now there's different kinds of examples of this, but I'll just share one example, right? Because sometimes I hear from appraisers and they're like, "You're blaming us for the crisis." No, I'm not blaming the appraiser for the crisis, but within appraisals there were problems, right? So I saw an appraisal which stuck in my head where the appraiser had used 3 comparable sales to try and represent what the market is. And those 3 comparable sales, turns out they never actually happened. The appraiser made them up. They were pure fiction. We didn't know it when we bought the loan because we didn't get the paper. We didn't see the paper. We found out afterwards, years later, when the loan defaulted. And it turns out there were real sales that the appraiser could have used, but they were much lower in price than what the appraiser invented, so to speak, right? So coming through this process, I think Fannie Mae very quickly realized we need a better way to validate appraisals. Because if someone can just make stuff up and nobody catches it, that's not a good system, right? So in about 2010, we announced something called the Uniform Appraisal Dataset, which is essentially a specification or a standard for how to report appraisals in a consistent way. Your appraisal report from now on, when you're talking about bedrooms, bedroom means this, and you're going to put the count of the bedrooms in this box on the form, right? When you're talking about bathrooms, a bathroom means this, and you're going to put the count here. And you're going to do all of this in what we call an XML format so that the machine can read it. Or in other words, so that you can deliver this appraisal not in paper, but in a digital file, a digital file that's readable on the other end by a computer system. So we announced that UAD in I think 2010, and I wasn't at Fannie Mae yet, but I was aware of this happening. And then in 2011, both Fannie Mae and Freddie Mac, the other GSE, I guess there's other GSEs in the federal home loan banks, but Fannie Mae and Freddie Mac jointly announced a web portal called the Uniform Collateral Data Portal, or UCDP, where lenders could deliver their appraisals to us in digital format, machine readable format, UAD format. And this was going to allow us to look at the appraisal before we buy the loan, or potentially shortly after we buy the loan, right? We would have actually lifetime access to the data in that appraisal, instead of making someone go to the warehouse and dredge up the paper and mail it to us. So this was a huge innovation and enhancement in our business model, where we'd be able to have instant access to appraisal information at any point in time. And we made that mandatory in, I think, April of 2012, which means all loans sold to Fannie Mae since 2012 have had, or that required an appraisal. We have that appraisal right now in our database in a digital format. We can refer back to it as needed. So let me kind of pause there. That was the beginning of a huge amount of innovation within Fannie Mae, because now we had information that we never had before.
I'm curious, Lyle, I remember that time well, in this 2007, 8, 9, 10 period, where there were a lot of foreclosures, there was stress in the housing market. I think, you framed it well as far as, what led to it. And I've heard the same thing. I mean, I don't think the appraisers that caused that, there certainly were the appraisal problems, but there were just market dynamics that led to that being an issue. I remember, the loan originations were low at that period. There for the appraisers, there was a lot of repossession or REO type of appraisal work being done corresponding to these foreclosures that were taking place. It seems like if we speed up the clock from then till now, Mark and I were having a conversation on a previous episode about just the time that it takes to go through the foreclosure process, and we're not seeing very many foreclosures or very much foreclosure work. But I'm curious about your perspective, contrasting that era with what we're seeing today in the foreclosure space. Has the process changed from your perspective, or maybe from Fannie's perspective, of what it takes to foreclose and that foreclosure process, or is it still kind of similar in business as usual from what that great financial crisis aftermath was?
Well, nobody wants a foreclosure, right? It's bad for the borrower. It's bad for Fannie Mae. We lose money on foreclosures. It's bad for the investor. So everybody is in universal agreement that foreclosures are not the desired outcome. However, you also cannot tolerate people taking out a six-figure loan and never paying it back. As a society, that's what you call a moral hazard. That's unacceptable, right? That would bankrupt our system. So you have to somehow enforce the terms of the mortgage, but you hate to enforce it through a foreclosure if you can avoid it. So there are a bunch of other what I would call workout options or off-ramps to a delinquency. And one of those is, for example, a short sale. So I'll put it to this way. I'll use my own house, for example. We refinanced in 2011. So we've been paying on our mortgage now for 14 years. And at the same time, we've seen home prices appreciate substantially in our neighborhood. And we had a down payment or some equity in our home when we refinanced. So if I were to sell my house today, or let's put it this way, let's say I lost my job and now I don't have money to pay back my mortgage. So I'm in danger of defaulting on my mortgage. What do I have? Like, I have a huge amount of equity in my house. I only owe this much, but my house is worth this much. So the prudent thing for me to do, if I can't arrange financing, if I can't find a new job, or I can't borrow money somewhere to make that mortgage payment, it's still due. The prudent thing to do would be to sell my house. I could maybe go buy a smaller house, right? The one that I could afford. Or I could live in a rental until I get back on my feet or something like that. But if I sell my house, then I don't have that black mark of a foreclosure on my credit, and I don't lose my equity when the bank comes and takes my house away from me. And so and plus then the bank doesn't have to go through all the legal apparatus of executing a foreclosure. So it saves them a lot of operating costs. So the prudent solution would be for me to sell my house. And then I would take that proceed and pay off my mortgage loan. I'd take the residual and either go buy a smaller house or maybe put that in the bank until I'm ready to buy. Now, the question is, and we saw this a lot in 2009 and 2010, if I had bought my house recently instead of 14 years ago, what if I had bought it a year ago? And what if instead of having a 20% down payment, I had put 3% down? And what if home prices, instead of going up, were going down? So then maybe my 3% down payment got lost because the market went down 10%, right? Now I'm 7% underwater. If I try and sell my house, I won't get back enough money to pay off the mortgage loan. I'll still owe, right? So then selling my house isn't really an option. Well, but it could be, because Fannie Mae will entertain what's called a short sale in that kind of situation. Before we will accept a short sale, we need to get a good handle on the value. So let's say you bought that house for $400,000 a year ago or 2 years ago, and we get an appraisal and we find out it's only worth $350,000 now. Then we'll say to you, hey, you can sell it for $350,000 because that's what it's actually worth, and we'll write off the difference, right? Under certain circumstances, if you qualify for this program, we'll write that off. Better for us to write that off than to put everybody through a foreclosure where our losses will be even bigger, right? So that's an example. In all of the other options, whether it's a third-party sale at foreclosure auction or whether it's an REO sale, all of the decisions or loan modifications are all driven by, hey, what's the value of the property today? What options are available to you based on how much equity you do or don't have in the house, right? Now, what I've seen is, first of all, Fannie Mae and the whole industry in general did a creditable job coming out of the housing crisis of improving our underwriting standards. We've all heard of things like the liar loans or the no doc loans. Like, we don't do that anymore. We're not going to do no doc. Everything is validated in terms of your income and your down payment and your financial capacity, your debt to income, and in terms of collateral also. So we're validating everything. So we're underwriting, or we're requiring the primary market lenders to underwrite in a way that they know what the true risk of the loan is. And we've been, I think, very successful with that. And that's one reason why defaults and foreclosures have been so low over the last 10 years, is because the credit quality on our loan acquisition portfolio is so much better than it used to be. So that's a big part of it. First you want to do is just avoid losses. Don't make bad loans. And if you don't make bad loans, you won't have to worry about how to handle them when they default, because they won't default. But I think on the collateral side, we've also done a great job. Like this creation of UCDP has meant that lenders and their appraisers are more accountable for what's in their appraisal. They know that we're going to see the appraisal. They know that we're going to review the appraisal. They know we're going to catch fraudulent appraisals. And so they're really much more careful about what they allow to be in the appraisal report. So we see, I think, a better quality of appraisal today than we did before UAD and UCDP were invented.
This downturn for appraisers, as far as we are concerned, has kind of cut deeper because there isn't this level of foreclosure business. This was sort of a diversification for appraisers, as crass as that is, that would naturally happen. And that hasn't come this year for, I think, a lot of the reasons that you have described. A concept that I hear a lot is the concept of forbearance, which my understanding is kind of a wait and we'll figure it out kind of thing. And let me know if I've defined that term correctly. But then secondly, is that generated from Fannie, or is that generated from like some political influence? What can you talk about that process?
Well, you're straying out of my area of expertise, right? Because
Okay.
it is collateral. But I can just share kind of at a high level. Fannie Mae does define situations in which we will offer forbearance, or we will allow the servicer to offer forbearance. And generally speaking, this is intended to be a temporary solution. So, for example, you think about the wildfires that happened in Los Angeles last month. A lot of people displaced, right? A lot of disruptions in terms of housing, and they might not be able to make their mortgage payment in the short term. But after every major disaster, there is a recovery. And in the recovery, a bunch of things are going to kick into action. So the insurance companies are going to be paying on claims. FEMA is going to be providing assistance. There may be state programs providing assistance. People are going to go back to work and start getting their paycheck again. Homes are going to get rebuilt. And so at some point in the future, and it's probably not going to be that long, maybe a year, maybe 2 years, a lot of the disruption will be over and people will be kind of back to normal. And so forbearance is intended just to bridge that gap. Like these people are not bad credit risks. They're not intentionally defaulting on their loans. They're just in a tough temporary situation because of something that's completely out of their control. But our past experience is almost all of them will get back on their feet. And so you just have to give them a lifeline until that happens.
Yeah, I like that framing. It makes sense that it's a temporary situation. The wildfires, I think, is a good example, of that. In fact, we're hoping to talk with somebody who's very intimately familiar with what's going on, in those recent wildfires. It's interesting, Lyle. I mean, I think you framed the scenario of a foreclosure with a lot more empathy maybe than Mark did, as far as just wanting some business diversification. Just kidding, because I think everybody's been touched by, like the challenges that come. I mean, man, it's when things are hard and paying bills is a legitimate struggle for people. I really, nobody in seriousness means to, make fun of that. There has been some challenges through, this period that we talked about at the personal level with, with the foreclosures that went through. And obviously there was stress in the housing market. There was stress for Fannie and Freddie, that resulted in a conservatorship status. I'm curious about any forward-looking perspective, that you may have, Lyle, for whether the company or even just personally your role at it, like what motivates you with where things are at in the moment, and a forward-looking vision of where you think things may go from the company, to the extent that you're able to comment on that.
Yeah, in terms of public policy and exit from conservatorship, that's way above my pay grade. I don't know what to expect. I think there's been stuff in the news media that suggests the Trump administration would like to move us out of conservatorship, but I think they are kind of pondering what's the right way to do that. So for me at my level, I don't really worry about those things. What I do focus on is I want Fannie Mae's business model to be successful. That's my job as a Fannie Mae employee, right? And if I succeed at that, then that'll make us more sound. We'll have better capital. We'll have lower risk profile. That'll make it easier for those policymakers to figure out. It'll give them options. Like you'd rather be trying to bring a very successful, well-capitalized business out of conservatorship than a poorly refund, bankrupt business out of the conservatorship, right? So that's kind of our goal, is let's maximize our efficiency and our profitability, and just execute business with excellence, and that way we create the conditions where the public policymakers can do their thing.
So Lyle, we were getting into and kind of arrived at the creation of the uniform appraisal data set, and we now have a database of appraisal data that is digitized and accessible everywhere. It seems like that formed the foundation and the basis for you guys to get, I don't know, creativity is the right word, but develop a lot of tools that are implementing, and I think the topics of the day: market condition adjustments, new hybrid policies, new UAD, new forms. All of these things are in appraisal waivers, which has been something we've had like 5 episodes on. These are all sort of made possible on some level by the beginning of the building of that database.
Yeah, that's exactly right. The appraisal data has been a wealth of information for our business. And I'll give you a couple of examples of how some of these things might work. Let's say that, so prior to UAD, UCDP, we got appraisals, traditional appraisal on most mortgage loans. Actually, not all. There were some carve-outs going back as far as at least 1998, but on most loans. And we used that tool kind of indiscriminately. Like we had one set of rules for appraisals, and we required that set of rules to be executed on almost all loans. And so it's a one-size-fits-all solution. But mortgage lending, or any lending, is not really a one-size-fits-all problem. And I'll give you an example. On the credit side, there's a bunch of different trade-offs. So, for example, if you have a super high credit score, like a pristine credit history, you may be eligible for a loan at a higher debt-to-income ratio because we know you're capable. Or if you have a super high debt-to-income ratio, like the debt-to-income ratio, the credit score, the reserves is like how much money you have in the bank that you could use to pay the mortgage if you lost your job. These 3 things sort of trade off with each other. And if you have a really big down payment or really strong reserves, we might accept a loan from someone with a lower credit score. If you have a really fantastic credit score, we might accept a loan from somebody with less reserves or less down payment, right? And same thing with the debt to income. If you have a really low debt to income ratio, then that allows some trade-offs on some of these other credit characteristics, right? So we didn't have that in collateral. And collateral is like everybody gets the same solution no matter what. And so think about this scenario. Let's say you bought a house in 2006 and interest rates were whatever they were then, 7%, 7.5%. And then and you had a big down payment. Like you sold your starter home and you're in a move up situation. So you bring 30% down payment, right? And now you pay on that loan for maybe 5 years. So we're in 2011. Your home value may have gone down in the crisis, but you're also paying down your mortgage for 5 years, and you already had a big down payment, right? And now interest rates are much lower. Interest rates are like 3.5% instead of 7.5%. So if you go to your bank and you say, I want to do a rate term refinance, not going to borrow any new money, I just want to get a lower interest rate. What is the risk? What is the risk to Fannie Mae in that situation? You've got a lot of equity in that property. You're very good credit risk. You're not taking out any new money. We saw this property once before in 2006. We have some idea what it looks like, right? This is a really safe proposition. Particularly if you have even more equity, if you're like a 50% equity stake in your own property and it's your primary residence, at some point I have to question whether or not I really need that traditional appraisal approach. What difference does it make what your property is worth? If it's worth a little more or a little less, okay, you have 45% equity instead of 50 or 55% instead of 50, right? Well, it doesn't matter. This is a very safe loan. We're going to get paid back, guaranteed, right? And so at that point, spending money on an appraisal is a waste of money because it's not telling us anything that's going to help us manage the risk on the loan. So we kind of started with that basis of there are situations where getting an appraisal is in deference to all my friends who are appraisers, and I'm an appraiser too. It's like this is hard medicine. But the fact of the matter is, sometimes you're not helping manage risk. It's just unnecessary, right? Just not giving us anything useful. So in those situations where we have confidence that that's the case, we feel comfortable waiving the appraisal requirement. So now you've got, when we do that, and we made a big announcement in 2016 of a appraisal waiver that was eligible for lots of different loans, lots of different lenders. It's primarily focused on this rate term refinance bucket, but we found there are situations with other loan types, purchases and cash out refinances where the logic would still hold true. And we're using the appraisal data that we have received through the UCDP to drive these decisions. So an important part of our 2016 announcement was we had to have a prior appraisal on that property. And it had to be within the last less than 6 years, right? So we're saying, I've got a prior appraisal. I think that prior appraisal was a good one. It checks out in terms of our risk scoring. And you're asking for a rate term refinance with no change in principal balance. And all we're doing is improving your ability to repay by lowering your interest rate. And okay, yep, that just makes total sense, right? So that's one example of how this appraisal data helps us to make more individualized or customized decisions about future loans. You can leverage this information to decide what your collateral risk position is before you decide what you're going to require.
So you really, I think what I'm hearing you say is that there's on the analysis of the collateral, there's kind of a gradient now from, what we already have, we're comfortable with. We don't necessarily need a reevaluation. Recently, a policy for around hybrid that's still getting some sort of evaluation, but is a little bit different, maybe approach versus the kind of traditional appraisal process. Any perspective on the kind of updated policy around the hybrid offering that's out there?
Yeah, just to level set for your audience, Fannie Mae announced in February, this couple weeks ago, a new hybrid appraisal policy or an expansion of our hybrid appraisal policy. So what is a hybrid appraisal? A hybrid appraisal is one where the appraiser, the person who's determining the value, does not personally visit or inspect the property. They're sitting in their office, receiving information from other people, and then analyzing that information to determine the value and the property eligibility and so forth. So one of the pieces of information that they receive is what we call a property data collection, which means there's a second person involved, a person who's going to go to the property, and their only job is to visually inspect that property and collect all the property characteristics in a standardized format that can then be shared with the appraiser. And that format includes pictures, supposed to include 2 pictures of every room, one facing each direction, so you get the full 360 view of each room, pictures of any defects, pictures of anything that might add value, if there's a swimming pool or an outbuilding of some sort or a fence, and also a floor plan, so a sketch of the contours of the house, plus showing the interior walls so you can see the layout of the rooms, and a calculation of the square footage of that house. So all this information is given to the appraiser to help the appraiser do their job of determining the value. The property data collector, they don't know anything about value. They don't do value. They're just doing property data. So this is the final outcome. The hybrid appraisal looks just like the traditional appraisal. It's even on essentially the same form. There's a few very minor differences, but the way that it's manufactured is a 2-step process instead of a 1-step process, or a 2-person process instead of a 1-person process. So you ask, why would this be beneficial? Why would we want to do this? Well, I think one thing we learned in the refinance boom during the pandemic is that the number of people who are appraisers, qualified appraisers, is fixed and rigid. It's hard to change. It's hard to bring new people into the profession because there's a big learning curve. And so in some cases, there were shortages of appraisers as loan volume kind of went through the roof, right? We got 10 times as much loan volume, and we still have the same number of appraisers, and the appraisers couldn't keep up. And so we saw in some markets that the amount of time it would take to get an appraisal, the appraiser's just queuing it up. He's stacking up his orders, right? He's like, oh, I'll get to this one in 3 weeks, and I'll get to this one in 4 weeks. And our mission from Congress is to ensure liquidity in the marketplace. And I think you could argue that if you have to wait 6 weeks for an appraisal, that's not really a liquid marketplace. So that was a concern for us. And we feel like this hybrid process will allow the appraiser capacity to scale more quickly, because a portion of what's consuming appraisers' time in terms of driving around and going to properties can be given to somebody else, this property data collector, to do that task, and the appraiser can focus strictly on the valuation analysis. So that's the goal, right? Now, today we're in an environment where appraisal turnaround times are very quick, and so I don't necessarily expect we're going to see a lot of hybrid appraisals in the near term. But we wanted to get that published and into the toolkit so that it's available next time that those conditions exist. And locally, that could happen at any point in time. Let's say you're in a small town with one appraiser, and that guy decides to go on vacation or gets sick and has to go to the hospital. It's like you're stuck. Your mortgage market shuts down, or can you find an alternative, right? And this hybrid appraisal can help create some flexibility in those kinds of situations.
Well, I do think that we all look forward to there being enough volume coming back to start to have that pain point, or that concern again. And so it's we went through a period where it was very busy, and I remember having conversations with real estate agents and loan officers saying, hey, this is taking forever to get the appraisal back. It's impacting an ability to close. It's impacting an ability for borrowers to actually get into homes and that sort of thing. I remember numerous conversations where somebody was holed up in a hotel waiting to close on their house so they could actually take possession and move in. And so it's hard to maybe remember some of those days when things have been like lean, in the last couple of years with just macro environments. But there is a big ebb and flow, and to your point, it's not a trivial process to teach somebody to be an effective and competent appraiser. And so the elasticity of the supply of appraisers does not adjust nearly as quickly as an interest rate may change, and then demand for loans and corresponding appraisal services, that can change much quicker.
And that's what we saw, right? We saw this refinance boom from 2020 to 2022, and new people were starting to come into the appraisal profession, working as trainees, and they barely had time to learn the business before loan volume dropped because interest rates went up, right? So that's a typical. That's a very big concern for us, is that the ebb and flow of volume is out of sync with the actual capacity of the profession.
That makes sense. I know from firsthand experience that you can get your license to represent buyers and sellers as an agent in a shorter period of time than you can get licensed to become an appraiser. Same thing on the lending side. All of it takes some time and training, but those kind of counterparts in the real estate profession can adjust to increased demand faster than the appraiser population can. One last question that I've got. You've been very generous. Really appreciate you spending as much time with us as you have. We've touched on this new UAD, this new reporting data set. I would love your perspective on what impact that may have for those outside of the appraisal space, lenders and real estate agents, those that are going to be. An appraisal report is still an appraisal report, but from your perspective, what changes might others that are used to seeing appraisals be expecting?
Right. So the UAD that we use currently was the version that we rolled out in 2010. So it's 15 years old, and computer technology has changed immensely in the last 15 years, and database technology has changed, and so many changes in the technology space, right? Also, what we've learned through actual experience is that there were some gaps in that data set. I'll give you two or three examples. In the data set, we did not define swimming pools. It's an undefined characteristic. But in terms of value, it can be an important contributor to value, right? Similarly, outbuildings, barns, shops, accessory dwelling units, they're not defined in the existing data set, but they can be very big contributors to value. And there's a bunch of stuff in there where we just said, you know what, we could do better if we had better data. And we figured out where a lot of these gaps are. And so let's go back and revisit that data standard. There's a lot of stuff but captured in comment addendums in the appraisal report. Appraisals commonly have 2 or 3 or 10 pages of narrative comments. And how do you make sense of that? How do you find what you need in all of those comments? And so we figured out some of the most repetitive portions of those comment addendums, we could standardize that and create a data element for capturing that. So you wouldn't have to hunt for it. It would be in one place and it'd be standardized and machine readable, right? So there were a bunch of other things that were kind of out of sync. Appraisers have obligations for certifying that they've completed certain professional requirements, and the certifications in the form were out of sync with the current appraisal professional requirements. So we've tried to address all of these different kinds of things, and what we came up with is a dynamic appraisal report, where the appraisal report kind of scales to meet the characteristics of the property and the characteristics of the market that it's in. And this is going to allow us to have standardized machine readable data for a lot more properties and for a lot of property characteristics that currently aren't standardized. And this will allow us then to do a better job of sort of risk scoring those appraisals on an automated basis. That turns out to be really useful for us and for our customers, because I would argue most appraisals are a pretty good risk from a GSE perspective. Like, the appraisal is good, the property is good, the value is good, everything looks good, right? And when we can validate that automatically, it saves everybody a lot of time and headache in terms of underwriting and QCing the appraisal and some of the back and forth that goes on between lenders and appraisers. We want to eliminate as much of that back and forth and rework as possible. And we can do that by having better data and better analytics.
Well, Lyle, I thank you for as Jeff said, being so generous with your time. This is, I think the only thing certain is that whatever appraisers were doing yesterday, they probably it will be different tomorrow. There is so much change going on, and that makes it's a very nervous time. Both GSE changes, artificial intelligence out there. We are, I think, as a group, generally nervous about what's coming, and I think your willingness to go out there and talk to us a little bit about what you're seeing, why you're doing it, can at least help us understand a little bit better what is to come or predict what is to come for us. It seems like there is a world where appraisers absolutely are going to continue to be pivotal, but maybe just less of us as I see it, and efficiencies and alternatives all seem to be out there.
Yeah, Mark, I am very optimistic about the future of the appraisal profession. I think, appraisers are going to need to evolve how they work. Their role is going to evolve. They're going to have to become more of a data analyst. Everybody's got data now. Like, again, when I came into the business, nobody had data. I was providing the data to the lender. Today, everybody has data, and that means everybody can critique the appraiser if they want to. But also, within data, big data, there's always going to be inconsistencies and uncertainties. Like, you're trying to interpret a bunch of messy data. What does it mean? And appraisers are very well positioned to be able to tell lenders what it means and to be able to provide a rational understanding of the noisiness that's inherent in any natural set of data, right? So I see appraisers as becoming more about truly living up to their profession of being a market analyst and being a determiner of value, and spending a lot less time on like routine mechanical stuff like driving around and taking pictures. So I think that's really good for appraisers. We're going to be able to distinguish ourselves as intellectual capital in the American economy, as opposed to being sort of again, driving around, taking pictures, taking measurements kind of blue collar workforce.
Wonderful. Well, a great way to close out with a bit of optimism for our nervous audience, at least your nervous hosts. So thank you for taking the time with us today. We hope to have you back as things evolve, and keep going.
Yeah, really appreciate it, Lyle. Thank you for coming.
Yeah, thanks again for having me.
All right.